All right, hello everyone. Welcome back to my channel, Business Students. How are you doing? Welcome back to the learning experience. Today we're going to be looking at the commercial banks. We're going to focus on the commercial bank's role and services offered, and then we want to be able to discuss the relationship between the central bank and the government, the commercial bank, I'm sorry. So the relationship between the central bank and the commercial bank. Now I want to look at what a commercial bank is. The commercial bank, of course, is a financial intermediary that accepts deposits and channels some of those deposits into lending activities. So they allow you to put your money into the banks, and then they use some of those money that you put into the bank and offer loans. So when you put your money into the bank, they give you security. They ensure that your money is safe and that you earn a little interest on it, but then they use back some of those money as loans where they too will earn from this. So now we want to look at the function of the commercial bank. They're really there to accept deposits, your money that you want to put in a safe place, and in the meantime earn interest on it, and to give you loans, to provide loans for their customers. Some of the services offered by the commercial bank include various deposit options. So you have savings account, current accounts, and you can open your fixed deposits. They can tailor an account to suit your needs. They also have the night safety deposit box, and this is a safety deposit box located just outside of the bank, usually for customers to deposit their funds, their documents, or valuable items when the bank is closed. So, on a weekend, in the evening, on public holiday, you are able to put your valuables in those night safety deposit box, and when the bank is open, the relevant person will take those out and process as necessary. They also allow you credit and debit cards. Of course, credit card is not using your money, it's the bank allowing you to use their money for a specified time at a specified rate. That is the credit card. The debit card is you using your card, your money to purchase whatever you have. So if the money in your account is not enough for the value of the products that you're purchasing, you will not be able to make that purchase. They also offer advisory services so they can advise you on financial matters. They also offer overdraft. Overdraft is actually allowing you to withdraw more money than you have in your account. This is not for everyone. You have to have this has to be specified between you and the bank, requested and granted. So it's not a privilege to everyone. It's not automatic, right? It is requested and offered and accepted. And then you can go ahead and purchase something for more than you have in your bank, paying, of course, the interest for it. They also allow you to buy and sell foreign currency, and of course, when you have a check, you can take it to the bank and they will provide you with the cash. Now, what is the relationship between the central bank? The central bank, of course, we remember, is the bank of the country, right? So it's like the parent, and this commercial bank would be like the children, because we have a number of commercial banks in our country. So, as a means of regulating the activities of the commercial banks and other financial institutions, the government uses the central bank. Now, the relationship leads to the central bank telling the commercial banks when they change the liquid ratio asset for the commercial banks. So the commercial banks are required by the bank regulations to hold a certain percentage of their highly liquid financial assets in the central bank. Now, the highly liquid assets are those that can be converted to cash easily at short notice. For example, cash reserves. Now, this is necessary to ensure that the commercial banks can meet all their anticipated expenses. For example, meeting the demands from their creditors, from their customers to fund loans, right? But it also is a way of central bank influencing the economic activity. Now, if the central bank implements an increase in the liquid asset ratio, this has the effect of increasing the amount the bank must deposit with them. This reduces the amount of money in circulation and restricts borrowing. So you see that they're actually controlling the economic activity in the country. Now, the second one we want to look at is varying. That was just changing the liquid asset ratio. Now, we want to look at varying or adjusting bank rates. Now, the bank rate is also called the interest rate, that most of us would know it as. The interest rate at which the central bank lends money to commercial bank. And this is usually a short-term loan. Remember in the previous video, we looked at um, lender at last resort. So if they went through all the other options and they weren't able to get enough or what they required, then the central bank would lend them a short-term loan, and that is at last resort. Now, managing the bank rate is one of the ways, and remember, I said the bank rate is also the interest rate. So, managing the bank rate is one of the ways that central bank influences economic activity. So, by reducing interest rate, they can help to expand the economic activity. And by increasing it, they help to reduce economic activity when inflation is high or at a rate that they think is going to be problematic, right? So that is varying or adjusting. They can increase it or they can decrease it. And remember, when they decrease it, they expand the economic activity or more economic activity takes place. But when they increase it, they reduce it, right? And so now we're going to jump over to changing the minimum reserve arrangement. Now, can you imagine going to your bank to withdraw some of your money that you put into the bank and they tell you, "Oh, I'm sorry, we do not have enough money available for you at this time"? Can you imagine that? Well, the only reason this doesn't happen to you is partly due to the fact that the central bank ensures it does not happen, right? So it's like your mother, or your parent. You have to go to school and you come for your lunch money, and your parents say, "I don't have any for you today because I gave you too much yesterday." Right? If you understand that little scenario. Well, of course, all banks are required to hold a minimum reserve with the central bank just to ensure a minimum reserve, by the way, is a minimum amount of money that they have to have at the central bank, right? And this is to ensure they always have enough money, enough funds to meet significant withdrawals. So when we go to the bank, we don't hear, "We're sorry, we do not have enough funds to lend you for you to withdraw today." Not to lend, for you to withdraw out of your money that you have in the account. Well, so they all are required to hold minimum reserves with the central bank just to ensure that there is enough money for withdrawals. The central bank also demands minimum reserves are held before it allows banks to withdraw from them, right? So increasing of the reserve ratio by the central bank means that the lending financial institution have less money available. So you see how they are um, controlling the economic activity. So it ensures that they have less money available to lend out, which is going to result in a reduction in the money supply. So less money in circulation or less money in the economy. So if they want less money in the economy, they can get it done. And if there is not enough money in the economy, they can pump back into the economy. So an increase in the amount of money in the economy results in increased spending, right? And of course, a decrease is going to have reduced spending. So, this is the relationship between the central bank. To summarize, the relationship between central bank and commercial bank, it is characterized by a combination of regulations. So we have some rules. You have to do this, you have to do that. We have cooperation. So the commercial banks agree to do this, to do that. And remember, the this and that we're talking about is changing the liquid asset ratio, it's varying or adjusting the bank rate, and it is changing the minimum reserve arrangement. So, and then there is a mutual dependency because there is a dependent. Central bank depends on the commercial bank to come in with their money. Yes, and to even come at last resort to get that loan because they're earning from it as well. And the commercial bank also depends on the central bank to keep their money safe for them and to also have that loan to lend them when they need it, right? So, with the central bank playing this crucial, critical, pivotal role in overseeing the stability and efficiency of the banking system, right? So, all of this, the regulation, the cooperation, the mutual dependency, allows the central bank to play their critical role, allows the central bank, which is the parent, to play a critical role in the lives of the children, the commercial banks. I do hope that you are able to understand something from this. I do hope that you are able to discuss the relationship between the central bank and the commercial bank. I hope that you are able to also list the functions of the, or even describe the functions of the central bank and identify and describe some of the services offered by the central bank. Happy learning, happy studying. Until next time, thank you so much for watching.